Welcome back in time for Earnings Exchange, and today we are talking Paychex, also CarMax and Carnival Cruise Lines. Here with our trades is CNBC contributor Jeff Kilburg, founder and CEO of KKM Financial, in his festive red blazer. Jeff, thanks very much for being here. Let's start off with Paychex. Those shares, about 15% or so since its last report, where it beat expectations. It also raised its full-year guidance. Barclays recently upgraded Paychex, saying it's held strong in the face of industry headwinds, but still warned rising unemployment levels and the tenuous health of small business could be a problem. But it's been on a tear as of late.
It has, Dom, and I think that note does speak to the apprehension in the stock. So I want to be a soft seller here. If you own it, I think you take profits. It's only about 8.5% of its all-time high. So trading at 129-ish, I think it has the ability technically to come lower to about 115. So I'm hoping for an opportunity to potentially buy it at that level. But if you look at ADP, which is twice the market cap on a 3-year perspective, they're the same. However, there's opportunities, there's dislocations between these two stocks. I think you have opportunity to get in. So I want to buy this lower, but if you're long the stock right now, I think you have to be protective utilizing calls, owning put spreads, or flat out selling the stock here at this level.
So that's a consumer strength economy play. You say sell Paychex on that softer basis. Let's talk about CarMax, another consumer-ish play. Shares are up 3% this week. But Wedbush cut its earnings estimates, writing it expects weak used car sales and an income miss from CarMax's financing unit. Not to mention competition is set to ramp up as Amazon will allow car sales on its platform next year, Jeff.
And I'm going to look through the other lens. This is only about 11% off its all-time high, but I want to be a buyer here. And it's interesting. It is somewhat expensive on a forward PE, trading about 26 times, Dom, but I think there's momentum in the stock. Technically, it's taken over its 50-day and its 200-day moving average, so I think there's more room to run. And the one thing we've learned in Q4 is that if a stock has momentum, you do not want to be on the wrong side of that trade.
So sell Paychex, buy CarMax. And finally, let's talk a little bit about another consumer-focused name, which is Carnival. Shares are up 131% this year as the post-pandemic recovery in cruise lines continues. Analysts are expecting record booking demand and lower fuel prices to keep the positive momentum going. Susquehanna is also eyeing Carnival's debt schedule, noting that $2 billion in debt is maturing next year, with another $2 billion coming due in 2025. So what's the take on Carnival? Is a lot of the optimism already priced in?
I think if you cue a little modest mouse float on, I think Carnival has the ability to continue its trajectory upwards, Dom. So I want to be a buyer here. And more importantly, I think they've just done a great job of tackling that debt. They got debt laden, and yes, it's 40% off its all-time high. So I know it's having a tremendous year, but there's more room to run. And when you think about cruises, people are getting surprisingly more aggressive in their travel schedule. I just found out, I guess Santa Claus will be telling me here shortly that we're going on a cruise in 2024. So first-time cruiser myself, I think people are looking to find different experiences, and that's where they can participate. But this stock, if you look at, from where it was, it trades at a discount to Norwegian Cruise Line. So I think you have to be very considerate. This is a trade. This is not a long-term investment, because this chart from 2021 to 2022 to 2023 has been quite a roller coaster, Dom.
All right, so those are the calls that are on Paychex, CarMax, and Carnival Corp. Jeff, if I might turn your attention to the broader market commentary, it's the time of year when we look forward to 2024 and the things that we could see. I wonder what your take is on the melt-up that we've seen in the markets overall, and this idea that there is just no concern about where the equity markets are going. I'm looking at my screen at a CBOE volatility index, which measures that volatility in the S&P 500. It's at 12 and change right now. The lowest point it's been over the last 5 years is an 11 handle. What gives? Why is there no concern in the equity markets right now?
I think there's two lenses to look through when you talk about VIX. And when you have an understanding of where the VIX is coming from, if you look just about 12 weeks ago, it was up over at 22 when there were some concerns. But here, down at this lower reading level, I don't think it's complacency, Dom. I think it's truly an option reading mechanism that's going to allow the next 30 days of expected volatility to be dampened. So I think there's cautious optimism. You've seen rates relent. If you recall, I had a very lonely view about 2 months ago that the 10-year note, which was above 5%, would come back to 4%. And here it is. So you're seeing the fruits of that rate relenting. I think the market continues to move higher. Are we stealing some of the returns from 2024 right now? I think the answer may be yes. So I don't think we're going to see 2024 be linear, but as long as rates have the ability, the Fed finally flinched and went into their pivot. So I think this is allowing some of these names, but I think you're going to find 2024 themes carryover from 2023. So the AI undercurrents, I actually put a piece out today on Options Pro talking about how Tesla is going to continue to move higher. So I think there's a lot of different things, but it's going to be a stock picker's market again because we saw such sector dispersion in 2020. That's going to carry over, but rates will drive the boat. That bond leadership is what I look for again in 2024.
All right.